South Africa's economy grew 0.6% in the fourth quarter of 2024. This is a modest rebound after the revised 0.1% contraction recorded in the third quarter. This brings full-year growth for 2024 to 0.6%, which is slightly lower than the 0.7% expansion recorded in 2023. Alna Mulman, a Standard Bank Group head of South Africa Macroeconomic Research, says this data reflects a very weak economy. Nedbank has reported a profit bump. The financial services group has posted a 10% rise in headline earnings per share. This was underpinned by good nominal interest rate growth, a lower impairment charge and targeted expense management, all of which offset muted net interest income growth, slower loan growth and margin pressure. A final dividend of 11 Rand and 4 cents has been declared. That's up 8% and brings the total payout for the year to 20 Rand and 75 cents. CEO Jason Quinn says the group remains cautiously optimistic as the economic environment is expected to improve, although risks associated with global geopolitics and trade wars remain. Alongside the results, Nedbank also announced leadership changes. Yolanda Reguero, who is the bank's managing executive for Nedbank Wealth, will be taking early retirement at the end of March. And Deline Dudoy, who is the group chief compliance officer, will retire in May. Nomonde Hlongwa will take up the reins from Dudoy. Impressive. That's how Shoprite CEO Peter Engelbrecht has described the retailer's performance during its half year. He says the gains are largely due to a sustained multi-year strategy focused on business expansion and market leadership. For the 26 weeks to end December, headline earnings per share rose close to 10%. An interim dividend of R2.85 per share has been declared. This is up 6.7% on the previous period's payout. Discovery has reported higher earnings at the halfway stage of the financial year, with strong contributions across the group's businesses. Headline earnings for the 6 months ended December rose 34%. Commenting on the results, CEO Adrian Gore stated that the firm has emerged from its cycle of significant investment, and so this positions the group for a new distinct phase of scaled growth. An interim dividend of 87 cents per share has been declared. Harmony has given its shareholders a reason to smile. The gold miner has declared a record interim dividend. Investors will receive a payout of R2.27. That's a 54% jump on the previous period's dividend. This comes as the group benefited from a rally in the gold price. The cost of the yellow metal increased 23% during the period under review, and this supported a 46% rise in Harmony's operating free cash flow. Earlier, I caught up with Harmony Gold CEO Beyers Nel to unpack the performance in greater detail.
We are blessed with a fantastic gold price. The gold price is really strong, and a lot of market commentators out there are saying that people are bullish about the gold price. But for us, it's important to say that we don't rely on this high gold price. I mean, we work hard to keep the underlying fundamentals of our business sound by making sure that we continue to improve our safety, deliver predictable, consistent production, and make sure that these good capital allocation decisions we made over the last few years to improve the quality of our ounces, continue to add value for our shareholders. So these good gold prices are, for us, on top of the good underlying fundamentals of the business, which we're trying to keep sound.
And of course, on the other side of the coin, we do have costs which do tend to be quite high for miners. Just talk to me about your navigation in terms of those costs, that cost management, so that they remain well within guidance.
Yes, our costs, we reiterated our full year guidance at the midpoint today. So we're quite comfortable that our costs are predictable in nature. They are largely rand-based, particularly the South African costs. So our cost in unit cost terms have gone up 14-15%, and there is a negative 4% on production. And then the rest of the cost is really inflation-related cost increases, which were predominantly labor, which is 55% of our cost basket, which is governed by our 5-year wage agreement that we signed with our unions last year. And then the Eskom costs, which is high, but it is regulated. So a big part of our cost basket is is predictable, and we can plan well ahead for our costs going forward.
Yeah, well, let's actually go into that production as well, down 4%. Of course, that largely expected. What is the runway looking like there in the short to medium term?
Yes, as you say, the downward production was expected. We guided along those lines at the beginning of the year, and just briefly, it was because we mined out a very high-grade part of the ore body at Hidden Valley in the previous year, and we had lower grades there, and then we've got planned lower production from our South African optimized assets.
Sea Harvest has had a hard time netting a profit growth. The fishing group has posted a 45% decline in full-year headline earnings. This reflects historically low hake catch rates, persistent weakness in global seafood markets, and rising interest costs. The factors outweighed revenue growth driven by acquisitions. The firm says the past year was one of its toughest since listing in 2017. To manage some of the pressures, the group has outlined a strategic focus on fleet expansion, price increases, and operational efficiencies. Growth between WBHO's Roads and Earthworks division has given the group a boost. The construction firm has reported a 19.5% rise in half-year headline earnings per share. This performance has translated into gains for shareholders. A dividend of R3 has been declared, reflecting an increase of 30% on the previous period's payout. Looking ahead, WBHO says it is well positioned for the short term. That's as it has a large baseload of work on hand within its African operations and a robust forward-looking pipeline. Canal Plus has delayed its takeover of MultiChoice by 6 months. That's to give regulators more time to clear the deal. South African competition authorities still need to give their nod of approval. The new deadline for the offer now stands at 8 October. And the process to finalize the delayed budget is now in the hands of Finance Minister Enoch Godongwana and the Treasury. That's as the Cabinet has concluded its discussions on the matter. A clear decision on how to fund the budget shortfall has not been proposed, and instead a task team led by Deputy President Paul Mashatile has tabled a variety of options to amend the budget. A statement from government says that the options take into consideration the fiscal constraints of the country. They also mitigate any impact on the poor and middle-class income households, and the options also support economic growth. The national budget is set to be tabled on the 12th of March. Further afield, 7&I's stock plummeted after reports emerged that the Japanese company, which owns 7-Eleven, intends to decline a massive $47 billion takeover bid from Canadian retail giant alimentation Couche-Tard, despite claiming to still be reviewing the offer. Let's take a look.
7&I shares fell on Tuesday. It followed a report the 7-Eleven owner plans to reject a $47 billion takeover offer from Canada's Alimentation Couche-Tard. The Yomiuri newspaper reported the update and said 7&I wants to enhance corporate value on its own. However, the Japanese company said it was still considering the offer. It added it's still committed to exploring all opportunities to unlock value for shareholders. It will also assess a full range of strategic alternatives, including the Couche-Tard proposal. It said its special committee, which evaluates the takeover bid, is engaging constructively with Couche-Tard. Reuters reported earlier 7&I is finalising a plan for CEO Ryuichi Isaka to step down. His replacement is likely to be director Stephen Dacus. He heads the special committee looking at the Couche-Tard bid and a take-private deal from 7&I's founding family that recently collapsed.